What's up, future millionaires? Welcome back to another video. This video is the second video in a series teaching you how to be an educated and smart investor. This video is going to be organized in such a way that it will start with the lowest risk investments, which are usually associated with the lowest reward, going up to the highest risk investments, which are usually associated with the highest reward. So, without further ado, let's get right into the video. Our lowest risk investment you can make is putting your money in a bank account. Technically, this counts as an investment because you are getting a small amount of money for having your money in a bank account, right? You guys have gotten it before. You check your bank account and your bank says, hey, we're giving you 3 cents, right? So technically, we'll count this as an investment. So why is this a low risk investment? Because for one, the chances of your bank going bankrupt are very low. Also, a government organization called the FDIC will match make what was in your account up until 250 grand. Meaning that if you had $50,000 in your bank account and your bank said they're going bankrupt and couldn't give you any money, the government would give you 50 grand. So it is very safe. The thing that's bad about putting your money in a bank account is that you won't be able to live off of 4% every year like I said in the last video. So over time, your purchasing power will decrease and you'll run out of money, which is not good when you're in your 70s and can't work. For these reasons, my suggestion with putting your money away in a bank account is that you make sure to put a percentage of your money away, but not have the money in your bank account be the money that you're trying to live off of every year using the 4% rule. It's okay to leave some of your money safe because say all your stocks went to zero, you still have some money left over, but it is not a good idea to just have all of it away and keep all of it safe because you will still lose it over time through a lack of purchasing power and by just using it in your day-to-day needs. The next investment on our list is gold, and I mean physical gold. If you buy gold, it is a very, very stable asset, meaning that your purchasing power won't go down. For whatever reason, humans have admired gold for thousands of years, and that is not likely to change. Meanwhile, things like dollars and other currencies have a shelf life. So, say the US was entering an era of hyperinflation where we were losing our purchasing power at a rapid rate, right? Then you could go and buy physical gold, and when everything bottoms out, you can go and take your gold and transfer it back into money and have the same amount of purchasing power as before. But let's do an example so that hopefully it's not too complicated. Say there was a car and it cost $10,000, right? And you had the $10,000, but then all of a sudden the US entered a whole bunch of inflation, so you decided to put your money into gold and wait because that car kept going up and up in price. So when everything bottoms out, that car now costs $20,000. You are able to take your gold and go and transfer it over to $20,000 because that is the new value of gold in dollars. So therefore, you keep your same purchasing power. Though, this is not really an investment as your money doesn't grow. So I only advise you do it when you see a huge catastrophic event going on in the world. It is not smart to take your money and switch it to gold every year because your money won't be having any compound interest. Although you will keep your purchasing power from all your paychecks across your life, you will not grow 7% a year like we said in the past video. Your money will stay stable at 0, which is not the best. So once again, my advice is to only do this in situations where your purchasing power is going down at a rapid pace. The next investment on our list is into a mutual fund or an ETF. To put it simply, an ETF is like taking your money and having it be split across a certain sector or part of the stock market. An example of an ETF would be SPY or the S&P 500. If you put $500 into that ETF, it would take it and put $1 into the 500 biggest companies in America. Basically meaning that no matter how much you put in, only 1/500th of that money is going into each company. So say Apple, which would be on that list, suddenly filed for bankruptcy, right? Your money would only go down $1, meaning that your money is very, very safe. The thing about it though is that your money also won't grow very fast. Say Apple had a record year and their stock doubled in value. You aren't going to see a very large reflection on the ETF price. Another name, by the way, for an ETF is an index. So if you ever see me use that word, that is the same thing as an ETF. A mutual fund has the same pros and cons as an ETF. A mutual fund, though, is like if you took your money and gave it to a team of analysts who are working full time to figure out which stocks are best for your money to be put in. The thing about a mutual fund, though, is that over time, they usually do about the same as an ETF. So it's not a big difference to which you put your money in. I, though, recommend that you put your money in an ETF over a mutual fund. My first reason is that ETFs take a smaller percentage of your money. Although both a mutual fund and an ETF will take less than 1% of your money, an ETF will take much less, like 0.04% or something like that. So you won't see very much money be taken from your account, whereas a mutual fund will take slightly more. This is because, of course, they have to pay their analysts in the mutual fund. The second thing that I like about ETFs a bit more than mutual funds is that with an ETF, you can make decisions that are closer to what you want, whereas with a mutual fund, you can't decide at all what stocks they pick. Say that you thought the entire tech sector will do really well over the next 10 years. You can go buy QQQ, which tracks the entire tech sector. But with a mutual fund, although you could probably find a tech-oriented mutual fund, they will pick their favorite tech stocks, not all the tech stocks, which you might want. My advice is that you leave a large percentage of your money in ETFs or mutual funds if you want the type of portfolio that you don't have to check often. Having your money in an ETF means that you don't have to worry day to day about it because you do not have to worry, for instance, that the 500 biggest companies in America are going to all file for bankruptcy. The next investment on our list is putting your money into specific stocks. This is where it starts to get a bit risky, but your reward can be a lot better, as I said. There are two different types of stocks. The first one is blue chip stocks. A blue chip stock is a quite established and big company. An example of a blue chip stock would be Apple. You aren't very worried about a company like Apple going out of business. Because they're more developed, this means you do not have to be very worried about your money going down over time. The thing about it though is as these companies are really big, they don't have very much room for growth left. You aren't expecting Apple to still triple in value in the next 10 years. These blue chip companies are good to get in if there is a big company that you specifically believe in. For instance, I believe that Apple is going to do really well in the next 10 years. So I would get to put my money specifically in Apple instead of, say, a tech ETF, like I said before. The other type of stock that you can put your money in is a growth stock. These companies are smaller and have more room to grow. The thing about it though is that these companies aren't as stable, so they're more volatile. Something being volatile means it goes more up or down in price at a faster rate. My advice with specific stocks is to definitely diversify your portfolio. You do not want to put all of your money into your favorite company just because you believe in that company. This puts your money at a higher risk, whereas if you put your money in your favorite 10 companies, you are a bit safer. My second piece of advice is that you make sure to know what risk you are willing to take with stocks. If you believe in a company like Tesla, you have to know if you're willing to take the risk associated with buying that stock. If you're not, it is not suggested that you buy it because you're more likely to sell at a time where you are doing it for emotional reasons, which usually results in a loss of money. Stocks are a great option, but once again, think about what risk you're willing to take. If you are a bit older, it is usually not a good idea to take on high risk stocks because you don't have as much time to bounce back. But if you are younger, you have a lot of time to make your money back, and you're usually playing with less money anyways. But overall, you got to figure out what risk is worth the potential reward. Our last and final investment you can put your money in is crypto, which is definitely risky. But the thing about crypto is it's kind of like a growth stock, right? Because it has a lot of room for growth. Some people think that a Bitcoin, which right now is worth about $30,000, could be worth $1 million in 10 years. Now, we don't know if they're right, but if they do, that would be a great return on your money. But at any given day, the world could give up on crypto and you could see your money go to zero in a matter of days because it is such a new asset. My advice with crypto is to make sure to never let it be the majority of your portfolio, for sure. Personally, for me, crypto is about 10% of my portfolio, which is a risk I'm willing to take. I am willing to lose 10% of my portfolio to gain those potential returns, but I'm not willing to risk, say, 20% of my portfolio. So never, ever put too much money into crypto, because the last thing you want is to not be able to retire or to reach your financial goals because you believed in such a risky asset. Thank you so much for watching till the end of this video. In my next video, I'm going to be going over some basic investing strategies which you definitely want to be around for. For that reason, I suggest you like, subscribe, and hit that notification bell because you will be able to know right when that video comes out and become an even more knowledgeable investor. Thanks for watching this video.